Wow, plus 2.7%. That's a massive overnight surge. That's how much the Nasdaq Composite roared back in just a single session. What a stunning rebound after a week of some pretty heavy losses. But here's the billion-dollar question, right? Is this rally the real deal? Is it built on something solid, or are we all just on a sugar high that's about to come crashing down? Okay, let's dive in and figure this out. You know, the whiplash in market sentiment has been absolutely incredible. I mean, just last week, the only thing anyone was talking about was a potential AI bubble and this growing fear of a market correction. And then, bam, in just 24 hours, that entire narrative has been completely flipped on its head, replaced by this huge wave of pure optimism. And the results? Well, they really speak for themselves. The tech-heavy Nasdaq, of course, led the charge with that huge 2.7% gain. The S&P 500 and the Dow also saw some really solid gains. And all this positive energy in the US definitely set a promising stage for the Korean markets. So what on earth caused such a sudden reversal? It all boils down to a single event. A whisper, really, from a very powerful source that completely changed the entire game. And there it is, this single comment from New York Fed President John Williams. This was the match that lit the fire. By straight up saying he expects a rate cut in December, he gave the market the exact crystal clear signal it was so desperately waiting for. The impact was immediate. I'm talking instant. If you look at the CME FedWatch tool, which is what traders use to bet on Fed moves, the probability of a December rate cut shot up from an already high 71% to over 80% almost in a blink of an eye. The market was listening, and boy, did it react. But that brings up the next obvious question, right? Why did tech stocks in particular just soar on this news? Well, it all comes down to a concept you could call financial gravity. So yeah, why this massive jump in the Nasdaq while the Dow just kind of shuffled its feet? What's the secret connection here? This analogy is a fantastic way to understand what's going on. Just think of interest rates as a form of gravity. When rates are high, that means there's a stronger gravitational pull on stock valuations, dragging them down. And this is especially true for tech companies because so much of their value is based on profits they hope to earn way out in the future. This breaks it down perfectly. When you've got high rates, that's our strong gravity. Those big future profits get discounted really heavily, which makes them worth less today. But when you have lower rates, weaker gravity, all of a sudden, those same future earnings are worth a whole lot more in today's money. And that gives tech stocks a major boost. With all this new optimism flooding in, market anxiety just plummeted. The VIX, the one they call Wall Street's fear gauge, it dropped by a significant 11%. It's like for a day at least, all the market's worries just seemed to melt away. And we saw this play out in specific stocks. I mean, Alphabet surged over 6%. And it wasn't just big tech. Even consumer-focused companies like Lowe's and TJX got a nice boost, probably because lower rates could mean more spending money for their customers down the road. But, and this is a really big but, this is where the story takes a sharp turn. This entire rally, this whole party, has been built on hope. And right now, that hope is on a collision course with a giant wall of hard data. So because of a previous government shutdown, we're about to get a flood of delayed but critical economic reports all at once. The market basically has to run a gauntlet of data today, and we're talking key reports on inflation, retail sales, and how confident consumers are feeling. So you see, this isn't just another routine data release. This is the first real test of this whole new market narrative. The market has priced in a rate cut, and this data is going to show us if that optimism is actually justified. Let's be perfectly clear about the stakes here. If the data on inflation and retail sales comes in too hot, if it suggests the economy is running just fine on its own, then the entire argument for a rate cut could just evaporate. And this rally, it could vanish just as quickly as it appeared. So what's the key takeaway from this wild market swing? Well, it really all boils down to that classic battle between what the market expects and what's actually happening in the real economy. Yesterday's 2.7% surge was a textbook sugar high. It was a rally fueled entirely by this sweet hope of a Fed rate cut. Investors just jumped on the good news, and it seems they conveniently forgot all about the anxieties they had just a few days ago. This captures the whole conflict perfectly. On one side, you have the market's powerful, overwhelming hope for a rate cut, and on the other, you have the cold, hard reality of the economic data that has to justify it. And here's the core lesson in all of this. Hope can be the spark that starts a rally. Absolutely. But for that rally to be sustainable, for it to keep going, it needs the fuel of hard data. Which leaves us with the final pressing question. Is today's Jada jump going to be the fuel that keeps this fire going, or is it going to be a giant bucket of cold water that puts out the rally before it ever truly gets started? I guess we're all about to find out.